Before we start the video, please take some time to read through the important notes and disclaimer. Do note that investments always involve risk and the possibility of losses. Any reference to prediction, projection, forecast on the economy, stock market, bond market, or the economic trends of the markets or past performance is not necessarily indicative of and is no guarantee to the future or likely performance of your investments.
Hi everyone, my name is Angie. I'm a wealth manager at AutoWealth. I have my Chief Investment Officer, Taichi, with me. Together, let us walk you through the growth and momentum portfolio. Taichi, over to you.
Thank you, Angie. I'm really excited to introduce to you the growth and momentum portfolio, which features factor investing at its core. Factor investing is an investment approach where stocks are selected based on particular factor attributes that drives returns. In this portfolio, we diversify across growth, momentum, and minimum volatility factors. All of our portfolios are specially curated by the investment team to reflect a particular theme or investment strategy or style that aims to deliver strong returns. Our portfolio curation process largely includes these three simple steps. Firstly, extensive qualitative and quantitative analysis is carried out to determine the styles that express the investment theme. The ETF's weightage is then derived to track the respective style's market capitalization. Our team then screen over 10,000 available ETFs listed globally and select the best ETFs for your portfolio based on various criteria such as diversification effect and risk-adjusted returns, etc. The process doesn't stop here. Our portfolios are reviewed regularly to ensure that the underlying ETFs are consistently the best ETF available in the market and the allocation weightage is relatively consistent with the market. Now, Angie will share more about why you should be investing through the growth and momentum portfolio.
Thanks, Taichi. Let me first explain what factor investing is all about and the different investment styles available. Factor investing is an investment approach where returns are driven by stock selection based on particular factor attributes. This strategy is well established by many financial literature and has gained increasing popularity over recent years. Some examples of investment styles under factor investing includes volatility, yield, quality, momentum, value, size, and growth. Okay, on my right is the MSCI Factor Performance Heat Map, which shows the performance of the various factors over various time periods. We observe that over the long run, both the momentum and growth factor has been the top three strongest generators of return. Taking the MSCI All Country World Index as a reference benchmark, both the momentum and growth target index have outperformed the benchmark by 1.5% and 1.6% per annum respectively. Let's look at these two factors in more detail and why you should adopt these factors. First, what is growth investing? Growth investing is a strategy that focuses on companies that are expected to grow at an above average rate relative to the market. This has been a popular investment strategy dating back to the 1950s. Growth stocks can be identified through two main characteristics: above average earnings growth and above average sales growth. Now that we have a clearer understanding of growth investing, let's see how the strategy has performed over the years. The graph here shows the performance of the MSCI World Growth Target Index, the blue line, versus the MSCI World Index, in green, from 1999 to 2020. The growth index has delivered outperformance relative to the market and historically generated excess returns over the long run with a 1.41% annual return over the world index. On the risk return graph, we observe that growth investing has delivered a higher risk-adjusted return as compared to the MSCI World Index. Another interesting thing to note is the cyclical nature of growth investing. Growth stocks are more sensitive to business cycles as they tend to outperform the market during economic expansion, as illustrated by the green arrow, but underperform during economic downturn, as indicated by the red arrow. So, what does this mean to you as an investor? First, this reinforced our findings that growth stocks tend to deliver long-run outperformance as the markets tend to go up in the long run. Secondly, the current bear market situation presents investors with a buying opportunity to take advantage of growth stocks that are trading at a larger market discount. Lastly, when market rebound, investors can expect growth stocks to provide exceptional returns. Then, what is momentum investing? Momentum investing aims to capitalize on the continuance of existing trends in the market by buying stocks that have been showing upward price trend or selling stocks that have been showing a downward trend. Momentum stocks are stocks with higher price momentum, which is measured by the stock's recent 6-month and 12-month risk-adjusted excess returns. Now that we understand momentum investing better, let's see how the strategy has performed over the years. The graph here shows the performance of the MSCI World Momentum Index, the blue line, versus the MSCI World Index in green from 1999 to 2020. The Momentum Index has delivered outperformance relative to the market and historically generated excess returns over the long run, with a 3.71% annual return over the World Index. So on a risk-return basis, we observe that momentum investing delivered a higher risk-adjusted return as compared to the MSCI World Index. Lastly, why do we allocate 10% to a minimum volatility ETF, in this case USMV, in our portfolio? The minimum volatility ETF seeks to track the index composed of US-listed firms that exhibit low volatility characteristics, which helps to provide downside protection for your portfolio. As seen from the left chart, minimum volatility have a track record of delivering market-like returns with less risk, as they have historically been more defensive during market declines, while still capturing meaningful gains during upswings. During market volatility, USMV is observed to lose only 67% of the total loss accumulated by the benchmark. This is again proven during the COVID sell-off period, where S&P 500 recorded a 12.35% decline, while USMV recorded a slightly smaller decline of only 11.93%. Okay, so all investments involve risk, and here are some key risks of factor investing you should be aware of. So first, factor performance has been cyclical and exhibit different level of risk at different points in the economic cycle. But on a historical basis, certain factor strategies have delivered long-term outperformance. A long investment horizon and a diversified factor portfolio can also help to mitigate such cyclical risk. Secondly, as majority of the growth stocks trade at a premium valuation, they tend to be much more susceptible to large price swing, which means higher volatility risk. However, investors with long-term investment horizon and suitable risk appetite will be able to tolerate the short-term high volatility. Moving on, Taishi will share more about the potential risk and returns.
Thanks, Angie. So what are the risk and performance numbers like, and how does it perform when compared to a benchmark? Let us look at the returns first. As mentioned earlier, factor returns can be cyclical and has generated periods of underperformance relative to the market. However, over a longer run basis, the portfolio has outperformed both the MSCI All Country World Index and the MSCI USA Index. The growth and momentum portfolio achieved a 5-year annualized returns of 15.06%, whilst the MSCI All Country World Index and MSCI USA Index has achieved annualized returns of 8.79% and 14.02% respectively. From a risk perspective, the portfolio's annualized volatility of 17.84% is also significantly lower than the reference benchmarks. On the maximum temporary drawdown, an indication of downside risk, the portfolio has also performed better with a smaller drawdown of 28.1%. Overall, if we look at the Sharpe ratio, the portfolio has a Sharpe ratio of 0.77, whilst the MSCI All Country World Index and MSCI USA Index has a Sharpe ratio of 0.33 and 0.42 respectively. This suggests the growth and momentum portfolio is able to generate higher excess returns relative to the risk taken as compared to the reference benchmarks. As mentioned in our introductory video, AutoWealth Plus portfolios are 100% equity and tends to be more volatile than the AutoWealth Starter portfolios. The Growth and Momentum portfolio is ideal for investors who believe in factor-based investment approach, specifically growth and momentum investing. Also, as factor returns are often cyclical, an investor should have a longer time horizon of at least 5 years to benefit from a reasonably full market cycle. Lastly, investors should have a high risk tolerance to withstand market volatility that occurs from time to time. If you are interested, all you need to do is to follow these 3 simple steps to create an AutoWealth Plus portfolio today. Firstly, open an account with us. You will need to head over to our website and click Get Started. Next, you will create the AutoWealth Plus portfolio by clicking the Plus tab and follow the instructions to fill in your goals, information, and risk assessment. Lastly, you pick a preferred AutoWealth Plus portfolio and start funding your account. Thank you for watching till the end. If you have any queries, please visit our website or drop our client services an email. Help us to improve our video content by scanning the QR code. Also, do look out for our next few videos as we deep dive into other AutoWealth Plus portfolios. Stay tuned and see you there.